Market. With us now to break it all down, the author himself, Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. He had a 6,500 initial target on the S&P 500 this year, just a little bit below the median of 6,600. So we have done a little bit better than that. But I think this idea, Mike, that you're always some great bear is incorrect. You have a pretty bullish target on this year. We're going to surpass. I'd rather be above a target than below it. What do you see then for 2026?
Hey, Brian, how are you? I think, the call for 2026 is just a continuation of our call this year. I think, as you pointed out, we're going to end up a little bit above our target for this year. The one thing we didn't do that most did was we didn't, capitulate in April. I think a lot of folks took their targets down. We stayed with it because our view coming into this year was that the administration would do the growth negative stuff first, and that would turn into a tough first half, second half being quite good. And that's exactly what's played out. It was a little more dramatic than we would have liked in April. But that playbook is working. And so now for 2026, we're going to see, more of the good news effects of the fiscal policy. And now, of course, the Fed getting on board to be supportive of this sort of run it hot strategy.
Yeah. Talk a little bit about that run it hot strategy, Mike. That caught my attention.
Yeah, no, I think we were first ones to talk about this. This goes back really to 2021. This isn't a new feature. And I think, in fact, the last administration was trying to run the economy hot too, but with a different strategy on how they would do it. And the Fed has to sort of acquiesce to that plan, because the only way we're going to grow out of the debt and deficit issue is to basically run the economy hot, which means not only getting the growth better, but also getting inflation higher. And the Fed has to be tolerant in that process. And I think they were tolerant in 2021. Obviously, they were late to kind of raise rates, but of course, then they had to react to high single digit inflation. And then 22 was a tough year. And now we're in the same situation, I think, that we were in 2021, which is we're going into a year where inflation is going to be accelerating again, which is very, very good for earnings growth, which is where we're out of consensus now. And it's okay for stocks if the Fed is being supportive. It's not okay for stocks if the Fed is, hiking rates or tightening policy like they were in 22. So we're back to this hotter but shorter playbook we've been using really since 2020 at the lows of the pandemic.
It reminds me of what Charlie Babrinskoy told us last hour as well, because the areas that you favor are very much the ones that he does too, like consumer discretionary, financials. So I don't know if industrials are on this list, small caps, some healthcare, you say software over semis. Are there individual names, or why do you think, for instance, consumer discretionary would do well in an inflationary environment? Obviously because of the pricing power, but does the consumer writ large hold up okay next year?
Well, that's it. That's the sort of, the tricky part about this. As I said before, inflation is going to be good for a lot of these lagging areas of the economy. Our view has been that we kind of went through a rolling recession the last 2 or 3 years. It bottomed in April. And now we're going to get, kind of an accelerating economy, both in terms of real growth and inflation. And that's quite good for earnings growth writ large. It's not just for, the large companies that can mitigate inflation. So it's good to a point, meaning the consumer can tolerate higher inflation as they're getting higher wages, which is, I think, part of the plan, too, with the policy changes, right? Restricting immigration is arguably good for real wage growth at the lower end, the middle class. And of course, the high end may suffer from wage compression due to AI pressures, but that's a decent rebalancing. And so the idea here is that we've had a 3-year recession in consumer goods, very low volume growth, and that now is changing, some of which is due to policy change and some of which is just due to pent up demand.